Hello, once again, options traders, and welcome back, everyone. Well, during these volatile times, it's a good question to ask, how volatile is volatility? And it's something that most new traders never even think to ask because they'll say, well, hey, if my broker's platform shows that volatility was 30% over the last 30 days, that's the number that it is. Well, is that really true? And is that going to get you into potential trouble? Well, as always, before we get started, please click like and subscribe. It's very much appreciated and definitely helps to promote the channel. So volatility is usually calculated over a 30-day period. This is what most of your brokerage platforms will do when they say ABC stock is trading at 20% volatility or 30% volatility. They're going back over the last 30 close-to-close periods and coming up with a number. And because every single broker will come up with exactly the same calculation, it gives the impression that it's something that's absolute. But what traders forget is that in the financial markets, it's not a steady process. It's not the same as if you are flipping coins, where that process never changes. Or if you're drawing cards from a deck of cards, that process never changes. It's a fixed source of volatility or a variation. That's not true for the financial markets. So there becomes this problem with trying to measure volatility. Going too far back may include irrelevant data. So by today's standards in mid-2022, if you go back too far, you're going to involve the COVID periods. Well, is that really relevant to today? Probably not. But on the other hand, it would be really nice to have a much bigger sample size and to be able to go that far back. And again, if we were drawing cards from a deck of cards, yeah, the more the merrier. Get as much data as you can into that sample size. But you can see where it can cause potential problems for financial markets. On the flip side, going back too little may miss critical volatile days or create more noise into the result. Anytime you have a very small statistical sample, you're going to have a lot more variation, no matter how good that sample might be. And you might also miss some, let's say, significant gaps that might have occurred if you're only going back 30 days or 20 days. So it becomes a tough question, how far back do you go? And this is probably why most brokerage platforms just default to 30 days. We're dealing with fairly recent data, and it's also good enough to be at least a decent sample size. However, ideally, calculations should be more frequent but over shorter times. So in a perfect world, you would like to see maybe every 15 minutes that the program goes in there and says, what's the S&P 500 now? Where is it now? Where is it now? And calculate a volatility. And so over a 30-day period, imagine how big your sample size would be then. So for example, over in the E-Trade platform, this is a chart you will get under the Quote tab. This happens to be Apple, and they will show you a one-year chart of your candlesticks, your daily candlesticks, and down below they show the implied volatility in orange and the historic volatility in blue. So it's really easy to say, if we look at this number in blue, 51.10, because that is an actual calculation over the past 30 days, it's very easy to get lured to sleep and going, oh, well, this is absolutely the volatility number of the stock. Well, possibly. And the reason is, again, even though that it looks like we're taking our average, our volatility number, over the population, in other words, 30 days out of 30 days, we have to remember that because it's a changing process, did we really capture enough data? Or do we capture too little? Do we capture too much? So it is, in a way, a small sample size. So here's the thing that you have to be aware of, that any statistical sample always contains noise, and the calculated average that you come up with may actually be higher or lower from the actual, or from the truth, from the actual population. So let's go back to our bell curve. Remember that for most types of data, it will follow a bell curve, and about 68% of your observations will fall within this blue area, what's called a 1 standard deviation zone. If we want to look at an even bigger proportion of the data, we can go to 2 standard deviations, and that comes up to be about 95% of all of our data. So let's go over to an Excel spreadsheet and take a look at some coin flip examples, and then we'll come back and see how it applies to volatility in the stock market. So here's an Excel spreadsheet, and what I've done is I've created a coin flip simulation of 100 flips. So it's just going to generate a random number 0 to 1. 1, let's say, is a heads, and 0 is tails. And so if we do this 100 times, we would expect to get 50% heads. Actually, we would expect that no matter how many times we flipped it, but we're going to be more confident with more flips. So up here on top, we have a 68% interval, and mathematically, if the expected average is 50, the highest we should get is 55, the lowest is 45, that is plus and minus 5 heads, but we should expect that 68% of the time. 95% of the time, or 2 standard deviations, we should expect plus or minus 10. So we should expect a high of 60 and a low of 40. So sometimes traders who are maybe just have a little bit of statistics or not real well versed with statistics, and they hear, oh, we've got a sample size of 100, coin flip, expected number is 50, it should always be really close to 50. And in fact, a basic premise of statistics is that under most conditions, a sample size of 30 will get you reasonably close. So hey, with a sample size of 100, this has got to be just about spot on accurate. Well, let's go find out. Let's try another set of 100 flips, and you'll watch, I've got these color coded, that if we ever break these boundaries at 68 or 95%, we're going to see some color codes. There we go. So we have actually broken the highest bound at the 95% level, and therefore we must have also broken it for the 68%. But look at that. You would expect 50 heads. We got 61. At the 68% level, we really shouldn't expect much more than 55. We got 61. That's 6 more than we would expect. That's a pretty big discrepancy. Let's try some others. Now, of course, at the 68% level, you should expect these boundaries to get broken more often, right? Because it's narrower, 45 to 55 instead of 40 to 60. So here we broke this boundary, the high of 55, whereas we didn't breach it for 95%. Let's try some more. There's another one. And you can see that about 1/3 of the time, we're going to break it for this range, because this is roughly 2/3. So 1/3 of the time we should be outside of here. And about 5% of the time, we should be outside of this range. So there we go. 39. So now we broke out to the low side. We would expect 50, and we got 39. That's 11 percentage points below, and that's on a sample size of 100. And so this often catches traders by surprise that aren't real well versed with statistics and with volatility, just how volatile it can be. There's another one at 39. Let's see if we can break the high side again. Try a few more. Happens quite often. That's the whole meaning of 68% confident, that 32% of the time you're going to be wrong. And at 95% confidence, 5% of the time you will be wrong. There's another one, 62 for the high. So you can see that even with a sample size of 100, volatility can be quite volatile. So what does this have to do with volatility in the stock market? Well, here's a simulated example where we have a stock at 30% volatility. And look what happens if we go to a sample size all the way out here to 2,000. You can see that we get very wide discrepancies early on, but it slowly starts to converge towards the truth of 30. And after about 500, we definitely reach diminishing returns. These red and blue lines are definitely getting closer and closer to that 30% mark, but ever so slowly. So here's where the real problems lie, is when you're in the short range, 30 to 100 or so. So let's zoom in a little bit right here and take a look. And now here's 30. This is what most of your platforms are using. So if 30% is the truth, look at how wide that range could actually be. And this is a 2 standard deviation move. But look at that, it's quite wide. So how are we coming up with these calculations? Well, volatility we can divide by the square root of the sample size. So again, if volatility is 30%, that's the same thing as the standard deviation. We take 30% divided by the square root of 30, comes up to be 5.5%. So if we take 30% minus 5.5 and 30% plus 5.5, we get this range. So what this is telling you is that this is a 1 standard deviation move. If the truth is that this stock is generating 30% volatility, we might actually measure it as low as 24.5 and maybe as high as 35.5. Well, that's a pretty big discrepancy. And that's just 1 standard deviation. 2 standard deviations would be double that, or 11%. And that means we might actually get as low as 19% and as high as 41%, even though the truth is 30%. So you can see where you could be pulled into a trap where if the truth is 30%, but you're measuring 19%, or at least that's what your broker's platform is telling you, you might be led to think, oh, volatility is super low, let me buy options. Or volatility is up here at 41, let me sell them, when it really isn't. And so the thing that you have to realize is just how volatile volatility can be. So what would happen if we doubled volatility to 60%? Well, once we run through our calculations, we see that a 1 standard deviation move is plus or minus 11 percentage points. So at 68% level of confidence, we would expect a low of 49% and a high of 71%. 2 standard deviations would be double that, or 22%, so we could actually get readings as low as 38% and as high as 82%, even though the truth is 60%. So not understanding just how volatile volatility can be can create perfect breeding grounds for bad decisions. So what can you take from all of this? Well, the best thing is to learn to think in ranges. This is really true for everything, but anytime you're talking about a statistical sample, don't look at one volatility number as if it's the only possible volatility. Even though your brokerage platform says, here's exactly what was calculated over the past 30 days. Understand that that volatility number you see is subject to a lot of variation. And the best defense is to always think in ranges. So even if you can't come up with the calculations, if you can at least hit the brakes and say, yeah, I know my brokerage platform is showing me that the number is 30%, the historic volatility, well, maybe it's really plus or minus 5% or plus or minus 10%. If you at least realize that there's a fairly wide range on either side of that number, it will help you to make better decisions. Always err on the side of caution, hedge your bets, and the best way to do that is with options. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the YouTube channel, Options A to Z's Facebook Trading Group, where you can find all of the archived videos from our trading group. And you can find a link in the description below.